What's going on is contagion. It's financial contagion. Does this somehow jump from crypto land to mainstream banking? And it did. Any thought that the problem's been solved, the bailout's complete, you're not going to hear more, is just not true. This is not over.
The rumors spread so fast. We've got Twitter, we've got social media, and we've got electronic banking. $40 billion being removed from a bank in 24 hours. I didn't even think that was possible.
He sent out like an SOS to Silicon Valley. He said, all of you, whoever you are, get your money out now.
When I worked in credit derivatives here in London for 10 years, two of my biggest clients were Credit Suisse and Deutsche Bank. And it was very hard for me to watch a massive institution like Credit Suisse literally just go bankrupt in front of my eyes.
Bank crises are now compressed from like 3 years to 3 days, which they are, including the weekend. The overlap between that group who really get it and the group who have an interest in making sure no one else understands it is large, meaning they're all in on it.
A couple years ago, I realized we were in an information war, but I haven't really thought deeply about how we're really in a financial war.
Battle space is financial. This is not just a financial economic ancillary vector to a kinetic war. You could argue this is the war. This is a global financial war.
Jim, did they just get him reelected by doing this?
Show me the man, I'll find you the crime. And that's kind of what this looks like. This is like a disease and their obsession with Trump. He wanted the handcuffs because, Trump, he'd be holding them up like this with a big smile. That would be worth 5 million votes right there.
The world is changing. Inspiration is everywhere. It has never been so easy to connect, share, and bring people together. We're learning from others and finding the best in ourselves. Challenging our beliefs. Sharing our vulnerability. Overcoming our fears. Transforming ourselves so we can transform the world. How far can we go?
This is London Real. I am Brian Rose. My guest today is... This is London Real. I am Brian Rose. My guest today is Jim Rickards, the American lawyer and investment banker turned economist, thought leader, and author. You have over 35 years of experience working in capital markets on Wall Street in senior positions at Citibank and the hedge fund long-term capital management, as well as being an advisor to the CIA and the Pentagon. As a highly sought-after financial expert, you've been a contributor to publications like the Financial Times and the Washington Post, while you are also the editor of the financial newsletter Strategic Intelligence. You have topped the New York Times bestseller list many times with titles including The Death of Money and Currency Wars, while your most recent book, Sold Out, looks at the broken supply chain, surging inflation, and the catastrophic consequences for the global economy. Recently, you have said that you believe that the Federal Reserve's new emergency lending program is the biggest bailout in history, and as always, the taxpayers will be left holding the bag. You've suggested we may find ourselves in a situation where the damage is irreversible and the collapse of the global economy is inevitable as more banks fail and the Fed continues to print money. Jim, welcome back to London Real.
Thank you, Brian. It's great to be with you.
Jim, it's always a pleasure and an honor to have these conversations. Before we get started, I just want to alert everybody to an important video that you've just recorded that won't be available to the public. Here, you discuss the upcoming crash that you say will be fast, bloody, and unavoidable, but then you also explain how anyone can position themselves to profit from this crash. Our viewers can access that video at londonreal.tv/Jim, and I highly recommend that everyone go watch that immediately after our conversation. Jim, where do we start? I mean, the last 3 weeks in the banking sector has been hard to fathom. You and I spent decades in the banking sector. I was talking to our good friend Robert Kiyosaki last week, and he said, Brian, they're centralizing banking. What is your read on Silicon Valley Bank, Credit Suisse, Republic Bank, Deutsche Bank, everything we've seen over the last 3 or 4 weeks?
Well, first of all, it's a good capsule summary, Brian. But of course, the Silicon Valley Bank was taken over by the regulators on March 10th. But you can see it coming. It was in distress. There was $40 billion pulled out of that bank in one day on Thursday, March 9th, the day before it was taken over. $40 billion just hit the road, just left. It was a complete collapse. And I was having a discussion with my editor, my managing editor of one of our publications, Strategic Intelligence, and we had, you work a little bit in advance, and I planned to write something for our April issue on climate change. It's a big subject, and I had outlined it. And he said, Jim, we got to do this banking crisis. I said, of course, let's put climate change down the road. We'll work on the banking crisis. So I started researching and writing on Silicon Valley Bank. And then I'll get into more detail, but 2 days later, they took over Signature Bank. So, well, we got two banks now. We got to, zero in on this. There was a crypto connection and Signature. We'll talk more about that. And then the next day, First Republic hanging by a thread. It's still hanging by a thread, by the way. Again, we'll go over all this in more detail. And so I couldn't write fast enough because as I'm writing, the story is unfolding. And then you get all the corruption, insiders selling stock before the crash. Mary Daly, the chief regulator, president of the Federal Reserve Bank in New York, she's running around doing LMNOP plus and pride flag and all this stuff. Fine, that's it's a free country. You can do that if you like, but she wasn't running the bank, and she knows nothing about risk management. She's a labor economist, protege of Janet Yellen, came up the ranks, but knows nothing about risk management or actually running a bank. So it just got worse, and then here comes Credit Suisse, right? The one thing I know, maybe a little before your time, Brian, but there was a very, very popular rock celebrity writer in the 1960s named Marianne Faithfull. She had a great career, lots of hits, Mick Jagger's girlfriend, etc. But her summary of the 60s, she said, if I wasn't there, it didn't happen. And I thought that was a very, very good way to put it. In her case, that was true. But I started to feel that way about financial crises. If I wasn't there, it didn't happen. I go back to the Herstatt Bank collapse in 1974, which was a shock. That was back before that was a foreign exchange crisis, but it highlighted the fact that when European banks closed and the U.S. banks were just opening, if you had a failure here, it never settled over here. It wasn't real-time settlement, so there was just all these open positions of a bank that had just failed. The S&O crisis in the 1980s, the Latin American debt crisis, the early to mid 1980s. The flash crash in 1987, the Mexican tequila crisis, 1994, long-term capital, Russia, 1998. Of course, I negotiated that bailout dot-com crash, 2007 mortgages, 2008, everything falls apart, 2020, COVID, and now today. So I don't know if I'm a magnet for trouble, but I've seen my share of financial crises. And as an analyst, they have certain things in common. The entities are always different, the currencies are always different, but the dynamics are very much the same. And the one thing I can say to our viewers is that this is not over. There's been a little bit of a sigh of relief. Stock market rallied a little bit toward the end of beginning of April. And okay, that's a normal reaction. But any thought that the problem's been solved, the bailout's complete, you're not going to hear more, is just not true. There's more coming. Get ready for it. I can't tell you. I'm not going to, pick a specific name, and we all know the names of the big banks that might be in distress. Is Deutsche Bank or Barclays or HSBC, Santander. I'm not picking on any of them. I'm just saying that there are more dominoes waiting to fall. The really interesting part about this, and again, we can come back to the specifics, is that the dominoes falling is a good metaphor. It's, if you got 100 dominoes, you knock the first one, they're all going to fall. That's just physics. So how do you stop that? How do you stop that crisis? Well, you truncate, you drop a steel wall between two dominoes, and this one hits the wall and this one's still standing. But that's the bailout. But the problem is each crisis tends to get bigger than the one before, which means each bailout gets bigger than the one before. My question that I'm wrestling with, are we now at the point where the needed bailout is bigger than the capacity of the central banks, that they've pulled all the rabbits out of a hat, played all their cards? And again, this goes back to what I did say about the Silicon Valley Bank rescue. It is the biggest bailout in history, and I can explain why. But if that's the case, and what else do they have? And then, so now we're dangerously close to the point where, as the crisis gets worse, it's no longer, oh, gee, let's wait for the Fed to bail it out, or let's wait for the ECB to bail it out. You get to the point, I think we're there, where you say, no, these guys actually can't stop it. And you lose confidence in the currency itself. It's the dollar. The crisis is the dollar itself, and the euro, goes along with that. And then that's the crisis. And there's no way to bail out a dollar crisis with dollars, because you're just pumping more of what people have lost confidence in. And then, then where do you go? And there are good answers to that. We've seen it again. We've seen it all before, but you have to kind of take the timeline out to 1,000 years, or the 1350s with the failure of the Bardi and Peruzzi banks in Florence, to see how these things can really play out. So this is big. It's not over. The regulators will attempt more bailouts, but we're at the point where I think you can start to question the regulators themselves.
You mentioned the velocity of this happening, and I want to just quickly talk about that, Jim, because you just said $40 billion being removed from a bank in 24 hours. Like, I didn't even think that was possible. And put that on top of, or maybe that's because of, the rumors spread so fast. And again, you've lived through this at Long-Term Capital Management in '98, and you've seen, like you said, a litany of bank failures. Tell me about this one and how it's different now, and I guess forevermore, with the fact that we've got Twitter, we've got social media, and we've got electronic banking. I actually still am flabbergasted that people like Peter Thiel could take out billions kind of online. I remember famously, Jim, when the mortgage crisis happened here, I wanted to get my money out of NatWest. And funny enough, right, when I called them, they wouldn't let me do it on the phone. They said, you have to come into a branch. And right. I said, oh, I see what you're doing. You're trying to stop a bank run. I'm like, I'm sure that's not legal, but I get it. They were putting frictions in place. I had to go and line up with 100 people. And then by then it was either going to be over, or I couldn't do it, or it would slow it down. But speak on maybe how fast the rumors spread, and then how fast people could get the money out, how that's different than the previous ones you've seen.
Well, you make a very good point, Brian. So let's go back to Brazil, Mexico, Argentina, the Latin American debt crisis, broadly defined in the early 1980s. That played out, the intense phase lasted about 3 years, 82, 83, 84. It wasn't until 1990 that we got around to Brady bonds, which were the ultimate refinancing technique. But the intense period lasted about 3 years. Come forward to 1998, long-term capital management. That was about 3 months. That was July, August, September 1998. SVB was 3 days or less. It was like Wednesday, Thursday, Friday, and done. And I talked to a guy. I know no reason to mention names, but runs one of the largest endowments in the world. And he said, Jim, we moved. We were moving $8 billion out of Silicon Valley Bank, and we got the wire transfer request in, but we didn't know, because you have to close business Thursday. We didn't know until Sunday that the money was going to move. We got a confirmation on Monday. We didn't end up moving the money, but there was about a 48-hour period there from Friday to Sunday when no one knew that the wires had been completed. The recipients didn't have them. It was just in limbo, and it worked out. One of the big crypto promoters, they forget the name. Well, the particular name of the bank, but they back one of the stable coins. Actually, it's USDC. Yeah. Had $3 billion in Silicon Valley Bank, and they talked about all these small entrepreneurs and startups. They got 100 employees and $5 million in working capital, and that money's gone, and they're all going to fail. There was something to that, but the fact is, you had Roku, Cisco, eBay. I mean, there were huge companies with multi-billion-dollar deposits in that bank. It wasn't all a bunch of little guys. So, but yeah, you can. In the old days, you had to line up around the block, and maybe it was raining. You're standing there in the rain, waiting for your turn to get up to the tower. Now you can be in line at McDonald's, with your cell phone, and just a couple hits, QR code, and boom, $10 million is gone. And what Peter Thiel did, and he was right. I mean, I'm not criticizing him. He got his own money out, but he sent out like an SOS to Silicon Valley. He said, all of you, whoever you are, get your money out now. And a lot of people did, and that was that $40 billion. So the time frame is becoming more compressed because of technology. You're exactly right about that, which means that the response function has to be equally compressed, or else you are going to have all the consequences of an honest to goodness global financial crisis. So, and I'm not sure if everyone knows the sequence, but on Friday night, March 10th, the FDIC took over Silicon Valley Bank, and they issued a press release, and they said, here's what we're doing. We're taking over. We're putting it into what's called a receivership. Anyone with $250,000 or less, your deposits are fully insured. No worries. You'll have your money Monday morning. And over $250,000, your deposits are gone. They didn't say frozen. They didn't say suspended. They said gone. And they gave you a receivership certificate, basically an unsecured printed up IOU from the FDIC, but not money. and it's a receivership certificate. And they said, hang on to them. In effect, we're going to sell assets, and as and when we realize proceeds from assets, we'll give you something. We'll give you distributions on these things. Don't know how much, don't know when. We'll do the best we can. Remember in the RTC days in the early 90s, it took them 2 years, and they were very efficient. I worked with them at the time. We were in their offices when we were sitting on boxes because they didn't even have furniture, but they were doing deals. So they had the right attitude, but that took 2 years. So and that was it. Well, that's when I call the billionaire crybabies came out and forced Bill Ackman, all these guys. Oh, you got to save us, I was like, well, you got to trade on Bill. $5 billion is not enough. But anyway, they pounded on the White House all weekend. Now here's something that very few people say, almost nobody knew at the time except the management, although they seem to be asleep at the switch. Everyone's like, yeah, startups, venture capital. There's a lot of truth to that. 97% of the deposits of Silicon Valley Bank were uninsured. And by the way, that's my new metric for assessing banks. You used to look at, working capital and debt equity ratios and, bad assets, governments. There are lots of ways to measure the health of a bank. But the most relevant way right now is, and this is publicly available, take the ratio of uninsured deposits to total deposits. 30% is comfortable. If you're like, 70% of my deposits are insured, which means they're not panicky. They're not necessarily going to run for the hills. 30%, okay, uninsured, but I have assets. I have that much cash or more. That's a comfortable ratio. When you get over 50, you're in the danger zone. Well, Silicon Valley Bank was 97% uninsured, which meant all the money was going to run, and it did. So that's a way, if you're looking at these big banks or any institution or your own savings institution, to look at it. But Silicon Valley Bank was a climate bank. Were they investing in startups? Yes. Were they investing in technology? Yes. But these were climate. These were green new scam startups looking at battery technology, chemistry, physics, to try to make a better battery. But not much improvement in the battery in 200 years, but they're working on it. Wind turbines, other sustainable fuel alternatives, et cetera. Again, I'm not do that if you like, if that's your field of research, but so much of this is subsidized by the government and then further subsidized by Silicon Valley Bank. And that's where the assets were. That's where the loans were, by and large. And so the White House is getting hammered, not only because of entrepreneurs, job losses, and by the way, we are in an election cycle here in the United States, but from the greenies who are extremely powerful. So that was Friday night. So Saturday, everyone's crying to the White House. Sunday night is 6 o'clock. By the way, mark that on your calendar. Sunday, 6 p.m. is when they tell you what they're going to do. 6 p.m. Sunday, November 12th, they came out on, March 12th, they came out on Silicon Valley Bank. The following week, 19th, that was Credit Suisse. And then the week after that was something else. But they always announce the collapse on Friday and they announce the relief on Sunday. So they have the weekend to work on it. But you got to be careful about 3-day weekends. Easter, Easter is an example. But so on 6 o'clock on Sunday, March 12th, 48 hours after the FDIC announcement, the government said, just kidding, the deposits are fine. They did a complete 180 under pressure from the Fed, the White House, et cetera. Even though FDIC did the right thing, legally, they said all the deposits are good, all of them, including my friend's $8 billion and somebody else's $3 billion, et cetera. And then they went further, and this is what I meant, Brian, by the biggest bailout in history. Jay Powell said to every member bank, not Silicon Valley, but every member of the Federal Reserve System, if you have underwater bonds, U.S. government securities, treasuries or certain mortgages, you can ship them to us. We will give you a loan at par value. We'll give you cash equal to par value, even though the loans are only worth 80 to 85 cents on the dollar, because interest rates have been going up for over a year. The value of the bonds goes down. That's bond math 101. Rates up, bonds down, prices down. Rates go down, the prices go up. Well, the rates have been going up, so the prices are down. So these bonds are worth 80, 85 cents on the dollar. But here's the Fed saying, we'll give you 100 cents on the dollar for your 85-cent bond on a one-year loan. So the loan was important because it means they didn't actually sell them. It was collateral for a loan, except you're under collateralized. And the Fed's like, okay. I said, I have a 14-year-old car that my dealer says he won't give me any money for. So I sent a tweet out. I said, hey, Fed, would you give me the $70,000 I paid for it? It's not worth anything, but let's get back to par here. That's what the Fed was doing for the entire system. But the thing is, Brian, you're talking about multiple trillions of dollars of bonds that fit that description I just gave you. Now, the banks are kind of saying, oh, that's good. That's a good deal. I'll take that. I'll do that myself. Here's something under collateralized. You give me the cash on a 1-year low interest rate loan. And now in theory, I've got all the cash I need to, pay depositors if they were taking the money out. But better yet, I don't have to record the loss. See, because I could sell the bonds in the market and get cash and pay my depositors. But the minute I do that, I've got to mark down my entire portfolio. And by the way, those unrealized losses, estimate probably $800 billion in the banking system as a whole. So you've got $800 billion of buried losses. And here's the Fed saying, we'll give you, 100 cents on the dollar, even though your bonds are worth 80. And you don't have to take the loss because it's structured as a loan, not a sale. So this is a multi-trillion dollar bailout. It's legal in the barest sense, but it's an accounting game. It's a bailout game of unprecedented magnitude. And by the way, we'll get, a year from now, March 2024, they'll extend the loan. I mean, it's only 1 year. Yeah, exactly. Right. You're not going to be able to repay this. Who says interest rates are coming down? We'll see, but they're not going to, they're just extended. So, but this goes back to my earlier point. What else you got in your bag of tricks? I mean, you just guaranteed every deposit in the system de facto. You just guaranteed par value for, trillions of dollars of government securities that are underwater. You just told everybody they don't have to record any losses. You've just given them all the cash that your printer can print with no consequences. But then they get, what else have you got? There's nothing else they can do. And one more twist on this. Remember what the Fed's been doing for the past 14 months. They've been raising interest rates. Yeah, we know that. But they've also been reducing their balance sheet. I run into people all the time. They bang the table. Hey, the Fed's got to stop printing money. They're printing too much money. They've been burning money. They've been reducing the base money supply for over a year, about a year and a half. Well, now, okay, so the base money supply is coming down. Rates are coming up. But what does it mean if $1 trillion worth of bonds show up and the banks delivering the bonds say, give us the cash? Where does the cash come from? The Fed prints it. So now you're going to expand base money by perhaps $1 trillion or more at a time when you've been pretending to reduce base money. So this completely blows up their monetary tightening. Okay, they're not cutting interest rates. That we'll see what happens there, but they are increasing the money supply by, again, estimate upwards of $1 trillion. So what happened to your inflation fighting? What happened to your monetary tightening? And they just want to pretend. I mean, you do have to be expert to understand all these mechanics, but they're not that hard to explain. I mean, you can just say it in plain English, which is what we're doing. But from a policy point of view, it completely blows up their monetary tightening.
Yeah, I'm really glad that you put that right out there in plain view, and I want to go deeper on that. Just want to say that you have recorded a video where you go really deep on this, on the upcoming crash that you say is going to be fast, bloody, and unavoidable, but you also explain how people can position themselves to profit from it. Again, people can watch that video at londonreal.tv/Jim. I highly recommend everyone watch that video. It won't be available on socials. Jim, when I saw them do that guarantee, I was like, so you just printed money, basically. You can call it this, you can call it that, you can mix it up, you can do this. You just printed money, which is the opposite of what you've been doing, or what you've been trying not to do, which is really hard for them to not do, but they've been trying not to do for, a year, 2 years. But that's basically what they did. They called it something else, fancy new name, but it's basically the same thing. And like you said, it's the largest bailout in history, but they would never say that. You're like the only one telling people that that's the case if you really drill down on the numbers. And again, they kick it down further. They kick the can down even further. Has anyone woken up to realize what's going on? Or is that the point, to just get the public looking past this?
That's the point. The universe of people who really understand this, certain lawyers, certain regulators, certain analysts, they're just experts because it's what they do, is pretty small. But the overlap between that group who really get it and the group who have an interest in making sure no one else understands it is large, meaning they're all in on it. The number of people who like really get it, they can raise their hand and say, I'm an expert in federal finance, government securities, and repo, and off-balance sheet accounting, and all that. And I think you're trying to pull the wool over people's eyes. That's like a handful. I mean, and I'm one of them. There are others, glad to say, but yeah, it's. I mean, and that's the other thing that really I just have low tolerance for, just the lies. If you have to do what you have to do, yeah, you don't want the whole system to collapse. I understand that, but you can be honest with people about it. So,
but Jim, let me ask you: they couldn't let that fail, though, could they? What would have happened if it failed? Because, like, we were going to feel it here in the UK. Like, the prime minister was meeting with the chancellor about what they were going to do, and then Israel's got companies. I mean, if they had let that sucker fail with 97% of the deposits. I mean, USDC, the stablecoin, was depegged, which boggled my mind that the CFO wasn't fired that weekend for keeping 10% of his money in an unsecured deposit account. I mean, I don't know where to get started, Jim, but like, what would have happened if they let it fail?
Well, one thing I really like about Britain is like every regulators, politicians, they mess up and they make mistakes, and it happens all over the world. But the British are really good at stepping up. They resign. If you've done very badly, you're a minister or head of something, and just things go badly on your watch, even if it arguably wasn't from, they resign. So I'll just resign. And Japanese do too. And someone takes their place. In America, we act like nothing's wrong. Nobody resigns. Nobody takes responsibility. I mean, I would have said Jay Powell, Michael Barr, who's the vice chairman of the Federal Reserve for supervision. So he's the guy who wears the regulatory hat. Powell's the chairman. And Mary Daly, who's the president of the Federal Reserve Bank of San Francisco. Why haven't all three of them resigned or been fired? I mean, this was not arcane. I mean, I'll grant, Brian, that you can get into derivatives and crazy off-balance sheet structures, and very few people understand it. And you don't see it coming. Okay, that's true. But this was simple. These were 97% uninsured deposits ready to run out the door with massive bond losses. And they were in like 30-year bonds, 10-year notes to 30-year bonds. It wasn't like you had treasury bills. So you can always sell a treasury bill and maybe take a little hickey, but not really. So you can have a government security, which is a treasury, almost no credit risk. I won't say none, but almost no credit risk. But there's always market risk. But the thing about treasury bills, 3-month bills or 6-month bills, there's very little market risk. They're not volatile. But when you're into 30-year bonds, forget it. I mean, you can take 20-point hits when you get the kind of interest rates we see, and that's what they had. And they put them in this held to maturity account, HTM, held to maturity. Means, yeah, we own them, but we're going to hold them for 30 years. And so therefore, you don't have to mark them to market, except if you sell them. If you sell one, because you got a run on the bank, you got to mark them all to market right then. And that's what this Fed facility was about. The CEO sold over $3 million worth of stock about 10 days before the collapse. Now he says, well, it was according to a pre-filed plan with the SEC, so it wasn't in response to any news or whatever. What do you have to understand? And there are such things, but these pre-filed plans can be part of the scam. In other words, I see it coming, so I'm going to file a plan so I can keep selling my stock. And then if I get accused of insider trading, I'll go, oh, it was all according to plan. Well, who's to say that the plan wasn't part of the scam? And that's the kind of stuff that was going on. The CFO sold a lot of stock. So that's certainly going to be investigated, but you could see this coming. But my point is, a bright high school kid with a spreadsheet could have seen this coming. You don't have to know Black Scholes in your sleep to see this. It was assets, liabilities, huge uninsured deposits, about $125 billion of uninsured deposits ready to flee, and a comparable amount, slightly more, of the most volatile. Yeah, government securities, okay, but extremely volatile, not that liquid in a crisis. That's all you had to look at. So where were the regulators? Where were the supervisors? And they said, well, we sent them a bunch of letters, and they tried out the letters as if that was exculpatory in terms of their regulatory incompetence. It wasn't. If anything, it made it worse, because oh, okay, you actually knew about it and didn't do anything. It'd be one thing if you never went over and knocked on the door, but you did. You saw something extremely risky. You sent them a letter and then didn't do anything. So, and again, this It's amazing how Washington works. Mary Daly, I mentioned her. She's president of the Federal Reserve Bank of San Francisco. She was on the short list to be nominated to the Board of Governors in Washington to fill the seat that Lael Brainerd left. Lael Brainerd was member of the Board of Governors. I believe she was vice chairman, but she left to go to the White House in the National Economic Council. She really is smart. She's a big brain. She knows what she's talking about. Very few of them do, but she's one of them. But she goes to the White House, but that's an audition for Secretary of the Treasury because they're going to throw Yellen under the bus. Yellen knows nothing. If Yellen were on this call right now, she wouldn't know anything we're talking about.
How is that possible, Jim?
Affirmative action. When she was chairman of the Fed, I said she was incompetent, and I was right. And then she became Secretary of the Treasury. She's a statistics geek from Berkeley. She's got a big brain. I'll give her credit on IQ points. So what? That's not the same as common sense or working knowledge or knowing how the street works. She's never worked, outside of government in her entire life. I don't care what your resume is. If you've never run a business, met a payroll, negotiated a purchase sale agreement, kept your morale up with negative cash flow. If you've never done any of those things, you don't know what it's like to be in the real world of the economy. She doesn't, but her specialty as an economist was labor economics. Okay, well, there's a place for that, but not as U.S. Treasury Secretary. You have to know she didn't know monetary policy of the Fed. She doesn't have fiscal policy of the Treasury. Knows nothing about international economics, and that gets us into the role of the dollar. She was like her husband won a Nobel Prize. Okay, George Akerlof. I know a lot of her close associates. If you don't want to say affirmative action, you can say the Peter Principle. Which, this goes back to the 60s. But the Peter Principle is you get in a bureaucracy and you do a good job and they give you a promotion. And then you keep doing a good job and they give you another promotion. And you keep doing a good job. And eventually you get promoted to something where you're incompetent. You're in over your head and you fail, but then you stay there because you're not getting another promotion. And so the result is bureaucracies are populated with incompetent people because they've all risen to their level of incompetence and have nowhere else to go. I would say she got there at the Fed, how she got another chance at Treasury, but that's the answer. But Lael Brainerd, I'll say, is more talented, and hopefully she'll be. So they'll throw Yellen under the bus, blame her. By the way, that's the Biden technique: deflection and denial, and just blaming other people. So they'll blame her for the whole thing. She probably doesn't see that coming. By the way, maybe she should tune into London Real, and then they'll put Lael Brainerd over there. But Mary Daly was on the short list to fill Brainerd's seat at the Fed. Well, you can forget that. She can't get to a hearing at this point. But she was running around on, climate change, social justice, George Floyd, BLM. And again, free country. You want to express a view, be my guest, but not as chief regulator of Silicon Valley Bank.
Yeah. It's so should they have let it fail? And what would have been the carnage, Jim, if they had?
Well, again, it's hindsight. You shouldn't have been allowed to get to that place anyway. But there might have been more. This is where there's a lack of creativity. It's kind of all or nothing. It's like, if this fails, we're going to have a wave of failures of startups in Silicon Valley. Well, that's probably true. But most of them fail anyway. If you know the venture capital business, and I'm sure you do, most of these things fail anyway. A couple of winners here and there. Well, how difficult would it have been? So now you're the entrepreneur. You had $5 million of working capital, which you got in a round, an angel round or whatever from some venture capitalists in Silicon Valley. You got some premises, you got a payroll, you got some developers, you got employees, all that stuff. And now your cash is frozen. Not just frozen, but gone. You got to look at Yang money, you got a due bill from the FDIC. Now who's to say if those companies were well run and they actually had some good technology, how difficult would it have been to make a few phone calls and say, you know what, we're stuck in this thing. I need a 2-year bridge loan, or I need a 1-year bridge loan. And I'll collateralize it by the proceeds of my receivership certificate. And as and when I get paid, I'll pay down the loan. We can have a simultaneous closing, all good. You could have got money. Some of those firms could have got money, some of them not. Maybe some layoffs. Maybe they would have failed, but most of them do anyway. I mean, that's my first point. But that was not the majority and unemployment would have gone up. I mean, I'm not saying that there are no hardships, Brian, but we gloss over the greater hardships on the economy as a whole. And that gets to the other lie, which was Janet Yellen coming out and saying, there's no cost to the taxpayer. Like, wait a second. Because you mentioned the bailout of the Fed taking the loans below market value and giving them, at market value and giving them par value, which is more for 1 year, and glossed over that whole thing. But there was a separate bailout, which is the FDIC guaranteed every penny of every deposit in all those banks. Well, when you look at the numbers, you have grossly depleted the insurance fund. The FDIC is an insurance company. That's what the I stands for. And they have reserves, just like every other insurance company. They charge premiums. That's how they go. This would have basically wiped out the reserves. So how are you going to top up the reserves in the FDIC for future bank failures? Well, they said, we're going to raise premiums on the banks. Okay, they are. But what do the banks do? Well, they're going to either pay you less interest or charge you fees. In other words, the bank isn't just going to sit there and write checks to the FDIC and watch their P&L evaporate. They're going to pass the cost on to the customer, which is us, which is the American people. So does your tax bill go up? No, but your interest rate's gone down, or your banking fees are going up. So the cost is shifted to everyday Americans. So don't tell me that we're not paying the bill, because we are. So again, these are in the nature of government lies to kind of, disguise what they're actually doing.
Yeah, at MIT Sloan School of Management, one of the lessons that one of my professors taught me early on was there's no free lunch. And there's none here as well. Just want to let people know you have just recorded an important video. It's not going to be available to the public. It talks about the upcoming crash, that, as you say, it's going to be fast, bloody, and unavoidable. But then you explain how people can position themselves to profit from the crash. Our viewers can watch it at londonreal.tv/Jim. I highly recommend people watch that video. Jim, I want to ask you about the international banks, because when I worked in credit derivatives here in London for 10 years, two of my biggest clients were Credit Suisse and Deutsche Bank. And it was very hard for me to watch a massive institution like Credit Suisse literally just go bankrupt in front of my eyes. And Deutsche Bank, again, one of the biggest European banks, one of the biggest derivative traders in Europe, again, at one point was faltering and looked like it might be going that way. What do you make of this international crisis as well? And again, how does this play out?
Well, that's a great question. I do think that's the next battle space, as we put it, in European banks in particular, but internationally. But there's a thread that runs from Bitcoin in November 2021 through Silicon Valley Bank to Credit Suisse. Let me explain what that is. What's going on is contagion. It's financial contagion. And the word contagion is not just a kind of cute metaphor. It's the mathematics of a viral contagion, which we've all just lived through with COVID, and we don't need to rehash that, and a financial contagion are the same. Robert Schiller pointed this out in the book, but I had identified it years ago, and I use it in my own analysis. It's called the SEIR model. And S is for susceptible, so like you might get the disease. E is exposed, you were exposed to it. I is infected, and R is recovered. So are you susceptible? Did you actually get exposed? Did you get the disease? And did you recover? They left out dead. I mean, there's recovered is like what's net of people who get it, and some of them die. And there are the banks that get carried off the field. But the math is the same. And so when we look at how disease spreads, financial panic spreads the same way. Now, this panic, you can say it started with Silicon Valley Bank, and that's fair enough. But this goes back to November 2021. That's when the Bitcoin crash began. So between November 2021 and November 2022, Bitcoin fell 70%. It went from about $68,000 to about $15,000. Now, I know it's back. It's up over 25. That's Bitcoin. But that happened. And a lot of people had Bitcoin loans. They had deposits in crypto exchanges that themselves had overinvested in Bitcoin or had leveraged bets on Bitcoin. So you were seeing a crypto crisis. You were seeing a financial crisis in crypto land with Alameda, FTX, of course, that was a fraud, Genesis, Three Arrows. There were and they're still happening. There are a whole series of crypto firms collapsing. And I was watching this, and the question I kept asking myself was, okay, there's a fire in crypto land. They call it the crypto winter. Does that jump from crypto land to mainstream banking? That was the question I was asking. It's in biology, it's called a zoonotic transfer. Does it go from the bat to the human? Although the Wuhan virus came from a lab, but the idea that there is zoonotic transfer is true. So I said, does this somehow jump from crypto land to mainstream banking? And it did. And the vehicle was not Silicon Valley Bank. It was something called Silvergate Bank. So now Silvergate Bank announced it was filing for bankruptcy the day before Silicon Valley Bank went down. But what's special about Silvergate Bank? Silvergate Bank was a regular bank. Remember the Federal Reserve System, FDIC insured, but it was completely in crypto. It was financing crypto lenders. It owned crypto, et cetera. And so that was the bridge. That was how the virus jumped from crypto land to mainstream banking. And then Silicon Valley Bank fell right after that. So now we have, we've gone over the kind of capsule history of Silicon Valley Bank and so forth. But now the contagion spreads to Credit Suisse. But let's get in our time machine and go back to 2014. Brisbane, Australia, November 2014. What happened? That was a G20 meeting. And it was not long after the 2008 financial crisis. And the biggest blowback out of 2008 is, hey, the taxpayers bailed out everything, which they did. They didn't get any reward, and all the big shots kept their jobs. Jamie Dimon's bonus didn't get whacked. I mean, they all kept their jobs. John Mack and Jamie Dimon, and you go down the list of names. Lehman Brothers failed. Okay, they were carried out feet first. But all the other banks were propped up by the Fed. I mean, Morgan Stanley was days away from failing. You go back over the history of that. They were calling John Mack saying, "Could you bail out Lehman?" He was like, "I'm kind of busy bailing myself out right now." And Morgan Stanley would have fallen. Goldman next, probably Citi. If J.P. Morgan was the last guy standing, don't know. But that's what was happening. As I said, they dropped the curtain, truncated it. They made Goldman Sachs and Morgan Stanley bank holding companies overnight. I've worked on bank applications. They take 2 years if they like you and 3 years if they don't. But this happened in literally overnight. Hey, you're a bank holding company, which meant the Fed could bail them out, and they did. But there was a big political reaction to that. This contributed to, the rise of Donald Trump, the rise of the Tea Party, Nigel Farage. I mean, there was just a lot of nationalist conservative blowback to this. So the elites at the G20 meeting said, we can't have that happen again. So here's the new deal. We're not doing any more bailouts. We're going to do the bail-in. And what's the difference? The bail-in is we're just going to whack the parties in interest. Equity gets, so in a crisis, in a collapse, there's a hole in the balance sheet. Equity gets wiped out. Depositors are going to get wiped out to the extent needed to fill the hole in the balance sheet. And senior creditors, we're just going to keep going and take money from all the holders of any level until the hole in the balance sheet is filled. And only then will the government get involved, but hopefully that won't be necessary. No more bailouts of bondholders, in other words, no more bailouts of depositors. That was the bail-in rule. So now come to Silicon Valley Bank. What happened? The FDIC actually did the right thing. They said, okay, bail-in applies. We're not going to go to the taxpayers or the insurance fund. We're going to say those deposits are gone. And they did. But that lasted 48 hours. And then they said, just kidding. The deposits are all good. So they abandoned. So this is nine years, 2014 to 2023. This is 9 years of living under the bail-in regime. And when they tested it, it only lasted 48 hours. Okay, so that was a joke. So now come over to Credit Suisse. And this is your question, Brian. What did they do? Well, if you were applying the Brisbane bail-in rules, you would have said equity zero, bondholders, okay, you're going to take a loss, et cetera. It's not what they did. When the Swiss National Bank did the shotgun merger, UBS gave $3 billion to equity. Now, that was down 97%. It was $100 billion at market not that long ago, and they got $3 billion, but they got something.
To continue watching the rest of the episode for free, visit our website londonreal.tv or click the link in the description below.